Has it ever crossed your mind why some venture capital firms, despite having access to vast wealth and industry expertise, collapse like a house of cards? It's a curious question, isn't it? The answer is not as straightforward as one might think. It's not just about the money or the market or even the entrepreneurs they back. It's a complex mix of factors that can lead to the downfall of even the most promising venture capital firms. To shed some light on this issue, consider the case of ABC Ventures. ABC was a venture capital firm that was launched back in the late 90s with a whopping $100 million in initial capital. They had the financial muscle, they had veteran industry leaders on their team, and they were ready to invest in the next big thing. But within a span of 5 years, ABC Ventures went from being a promising newcomer to a cautionary tale in the venture capital industry. What went wrong? The first mistake ABC Ventures made was chasing trends rather than investing in sustainable long-term ideas. They poured millions into dot-com companies, which were all the rage at the time. But when the dot-com bubble burst in the early 2000s, ABC Ventures was left with a portfolio full of worthless investments. The second mistake was not diversifying their portfolio. ABC Ventures put all of their eggs in one basket, the technology sector. When the sector crashed, so did ABC Ventures. A well-diversified portfolio could have cushioned the blow. The third, and perhaps the most critical mistake, was the lack of due diligence. ABC Ventures was so eager to invest and get high returns that they often overlooked the potential risks and red flags in the companies they were investing in. In our analysis of ABC Ventures, we've reached the fourth critical mistake: a lack of adaptability and flexibility in their business strategies. Venture capital is a dynamic field, subject to constant change and fluctuation. The business environment can shift rapidly due to emerging technologies, regulatory changes, or even global events. ABC Ventures, unfortunately, stuck to their rigid investment plans and strategies, failing to adapt to these changes. They were not proactive in managing the dynamics of the business environment. This lack of flexibility led to missed opportunities and, ultimately, contributed to their downfall. Remember, in the venture capital world, an adaptable, flexible approach is key to survival and success. As we further dissect the downfall of ABC Ventures, we encounter another significant misstep: a narrow focus on investment criteria. ABC Ventures primarily concentrated on early-stage startups, overlooking potential opportunities in later stages. This myopic vision limited their scope and potential for higher returns. Additionally, they heavily relied on the founder's academic credentials, which, while important, is not always a reliable predictor of a startup's success. This resulted in a lack of diversity in their portfolio and missed opportunities. Therefore, the lesson here is clear. Venture capital firms should broaden their criteria and explore opportunities beyond these conventional parameters. A more holistic approach to investment selection can lead to a more diverse and potentially more successful portfolio. The downfall of ABC Ventures serves as a stark reminder that venture capital firms need to be prudent, patient, and persistent. They need to invest in sustainable long-term ideas, diversify their portfolio to spread the risk, conduct thorough due diligence to avoid potential pitfalls, and understand and actively manage the risks associated with different businesses they invest in. So, what are the key takeaways from this discussion? Firstly, venture capital firms should avoid chasing trends and instead focus on long-term, sustainable investments. Secondly, diversification is crucial. By spreading investments across different sectors, venture capital firms can mitigate the risk of a single sector downturn, wiping out their entire portfolio. Thirdly, a comprehensive understanding and active management of risks associated with individual investments is fundamental to avoid failures like that of ABC Ventures. Lastly, due diligence is non-negotiable. Every potential investment should be thoroughly vetted to uncover any potential risks or red flags. Remember, the world of venture capital is not for the faint-hearted. It's a high-stakes game where the risks are as great as the rewards. But with prudence, patience, and persistence, venture capital firms can avoid the fate of ABC Ventures and achieve lasting success. Voiceover. The fourth mistake that we want to highlight, often overlooked, is the failure to leverage different geographies and innovative ideas. ABC Ventures primarily focused on local startups, missing out on the plethora of global opportunities. This narrow vision restricted them from tapping into the vast pool of innovative ideas stemming from varied cultural backgrounds. The world is a melting pot of ideas, and by confining their investments to local startups, they inadvertently limited the scope and potential of their portfolio. This lack of geographical and cultural diversity in their investments not only stifled their growth, but also made their portfolio more susceptible to local market fluctuations. So the lesson here is clear. Venture capital firms should broaden their horizons and explore global opportunities to infuse diversity and resilience into their portfolio.